Hello, I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. As the Greek saga continues, I caught up with Head of Investment Strategy and Chief Economist at AMP Capital, Shane Oliver, to find out exactly what it all means for Australian investors. Shane Oliver, always a pleasure to catch up with you. Thank you so much for joining us.
Thank you.
Okay, so we're talking Greece. Now let's rewind a little bit. 3 months ago, you told us that a Greek exit from the Eurozone would be desirable but not inevitable. How does your position stand on that now?
Well, I think it's still desirable in the sense that it would be nice to have them out of the Eurozone because they're just causing trouble in it. And this is now almost 6 years that we've had uncertainty about Greece. It started way back towards the end of 2009. So it's becoming a bit of a drag. And I think the rest of Europe is maybe thinking, well, they're just a bit too different from us. Be nice to have them out of it. The trouble is, well, there's two aspects. I still don't think it's inevitable that they will leave. They could even default and end up staying in the Eurozone in some way. But getting to that point where they've left the Eurozone, if they are to leave, is one that could cause a few ructions along the way. And so that's why, in a sense, I'll say it's still desirable. They'd probably be better off out of it, and we'd be better off if they were out of it. But getting to that point could create a few volatility and periods of uncertainty in markets.
Now, we've discussed previously that the Eurozone isn't a strong trade partner to Australia, and therefore investors are pretty removed. One thing I would note, however, is that we have seen several soft leads for the local share market off of poor Wall Street performance, and that is tied to sort of the Greece outlook at present. Is that perhaps our weak spot?
Well, yeah, there's two weak spots, I think. One is that what goes on in Greece obviously creates worries about the whole of the Eurozone. And of course, that has impacts on Wall Street. And of course, what Wall Street does have impacts on Australia. The second point, I guess, is that the Eurozone is China's biggest export market. And of course, Australia is heavily exposed to China. So if the Eurozone gets into trouble because of problems regarding Greece, then that can affect Australia via China. So it certainly does impact Australia. And it's noteworthy that when the Eurozone crisis was at its absolute worst back in 2011, the Australian share market fell 22% from a high point around April to a low point around September, October. So we were certainly affected by that, even though our economy was still motoring along at that time, and we had an iron ore price at $180 a tonne, a lot higher than it is now. So we can be affected by what goes on in Europe.
How does this all play out on the euro? You know, we've got potentially a country leaving the euro currency for the first time ever. How does that shift on your outlook for the single currency? And also, given that it is a G10 currency alongside the Aussie dollar, also, are there ramifications in that sense on even the Australian currency?
Well, our view on Europe hasn't really changed. You know, we're favourably disposed towards the Eurozone. We think that it's a lot stronger than it was when the Greek ructions first appeared, particularly through that 2010-2012 period. We've seen many of the countries back then that were seen as vulnerable, like Greece, come out of bailout support, notably Portugal and Ireland. We've seen those countries, plus Italy and Spain, start to reform their economies, get their budget deficits down. We've now got the European Central Bank buying up bonds across the region. Their so-called OMT, the Europeans are very long on acronyms, we find. The so-called OMT, the Outright Monetary Transaction Program, which is aimed at supporting countries that do get into trouble, that's been approved or supported by the European Court of Justice. So there's a whole bunch of things which I think are quite positive on Europe, and the share market is still cheap. It's now 10% cheaper than it was a few months ago. And you've got the monetary easing continuing in Europe, and underlying economic conditions, I think, are still on the mend. So we're still favourably disposed towards Europe, notwithstanding the short-term risks around whatever Greece does. In terms of the European currency, we would see that as a relatively weak currency, though, because Europe is pumping cash into their economy, increasing the supply of euros, and that puts downwards pressure on the value of the euro within the G10 or whichever way you want to look at it. So it's not a currency we're looking to buy into at the moment relative to the Australian dollar. We tend to prefer the US dollar.
Now, there has been some concern regarding sort of Greek contagion. We've also sort of, on the other hand, seen several smaller economies who got through the GFC reasonably well, now starting to stutter a bit. Prior to the interview, I gave you the example of New Zealand, perhaps a poor example in this theme. But are there any other red flags popping up for you at present?
Well, I guess the key red flag to look at in terms of contagion, and the contagion we're talking about here is mainly confined to the Eurozone, this fear that if Greece goes, then some other country in Europe will go. And of course, investors think, well, if they go, then we look around for the other weak countries in Europe. Right now, though, a lot of those are looking a lot stronger than they used to. But I'm thinking of Portugal and Ireland and Spain. But what you do look for is the spread. That's the bond yield that countries, that governments pay in Portugal or Ireland or Spain relative to, say, the German bond yield. And that spread has increased lately, but it's a long way from where it was back at the height of the Eurozone crisis. For example, in 2012, towards the tail end of the Eurozone crisis, Spain and Italy were paying, I think, over 7% to borrow money for 10 years. Now they're paying around 2.3% to borrow money for 10 years. So, in other words, if there is to be contagion, the market's not too focused on it at the moment. The telltale signs are relatively weak. And I think there's a degree of hope that either there's a deal between Europe and Greece, or alternatively, if they do decide to default and leave the Europe, that these other countries will stay there. So the markets seem to be a little bit more relaxed than they were a few years back.
Well, we spoke about Greece 3 months ago. I have ever such a small feeling we may still be talking about it in another 3 months' time. But Shane, thank you so much for your comments today. Much appreciated.
My pleasure. Thank you.
That's all we've got time for now with Shane Oliver at AMP Capital. However, naturally, the Dukascopy TV team will be bringing you all of the latest on the Greek story as it happens. For now, though, it's goodbye from me.